In 2020, thousands of investors poured hundreds of thousands of dollars into the wrong company. They thought they were investing in one stock, but they're actually investing in a completely different company. This is that story. So before we get into the specifics, I want to cover a few high-level topics about finance and the stock market in general. In the stock market, and really any financial market you can think of, one pattern that you can always expect is the basic of supply and demand. Prices will rise as people demand that product and vice versa. And another pattern that goes along with this is that if there's a company that is consistently growing their profits, releasing products that people like, and they're public on the stock market, you can expect that stock to continue to go up. Think of something like Apple over the years, how it has just seen continued growth as people continue to demand iPhones, iPads, whatever. So those are the basic ones. Next, we need to move to something a little bit more financy, and that's the efficient market hypothesis. This hypothesis states that every company's stock price reflects all available information about that company. Because information is so readily accessible and so public, the stock market prices of a company are always going to reflect all of the information available. The impact of this is that it would be impossible to outperform the stock market without insider information. Basically saying you can't try and predict stocks better than someone else because all stock prices are already reflecting all available information. Now, this is importantly just a theory, and there are many financial professionals who reject a strict understanding of the efficient market hypothesis. Over the decades of the stock market, you can find plenty of examples of whether individual investors or firms who have demonstrated their adeptness at picking stocks and have consistently outperformed the market year over year. A quote from Warren Buffett sums it up nicely when he said, "Ships will sail around the world, but the flat earth society will flourish." There will continue to be wide discrepancies between price and value in the marketplace. Anyway, that is the efficient market hypothesis. Again, it's just a theory, but I spent all this time explaining it to you because the story that we're going to talk about today is one of my favorite stock market stories, and it is one that stands directly in opposition to the efficient market hypothesis. So the story starts with a darling company of the tech world, the video conferencing startup Zoom. You've probably heard of them. The company was founded in California in the early 2010s and grew steadily throughout the decade until it went public on the stock market in 2019 for $36 a share. However, even though going public is obviously a very big milestone, this wasn't Zoom's time in the limelight. In fact, they were overshadowed by Pinterest going public that same day. And Pinterest at the time was a bigger, more recognizable company, and so that got all the headlines, whereas Zoom just kind of went public without a lot of fanfare. Zoom got its time in the limelight shortly after because of the pandemic. In 2020, the world was plunged into a world of remote work and lockdowns everywhere. And so the demand for Zoom skyrocketed. Zoom became synonymous with the time that people were spending online during the pandemic. As people connected with family and friends or interacted with coworkers, whatever it might be, Zoom was everywhere during the 2020s. It went from being just a successful startup to one of the most recognizable companies and logos in the world. So if you're a savvy investor sitting at home during COVID lockdowns, you might think to yourself, hey, everyone is probably going to start using Zoom, and that means the company's probably going to grow. This seems like a perfect recipe for a stock that's only going to go up. I want to buy some Zoom stock. You go to your Ameritrade account or Robinhood account or whatever, you type in Zoom, you buy the first stock you see, and you sit back ready to watch your money grow and grow. There's only one problem. Buying Zoom stock meant that you just bought the completely wrong company. So whenever you go public on the stock market, a company has to pick what's called a stock ticker. And this is a unique combination of letters and numbers to represent your stock. Your stock ticker is how people know and recognize your company on the stock market. And to keep them simple and searchable and recognizable, companies often pick stock tickers between 2 and 4 letters long. For example, Amazon is AMZN, General Electric is GE, Tesla is TSLA, and so on. So when Zoom went public in 2019, they did not go public under the stock ticker of Zoom, that is ZOOM. Zoom definitely should have had the Zoom ticker, it just didn't. Instead, the ticker that they ended up choosing was the simple ZM. Definitely not a bad ticker, but it's not the one that you might think it will be, which is just simply ZOOM. And this is because that ticker was already taken by a company called Zoom Technologies. Zoom Technologies is a defunct Chinese company that used to manufacture electronic parts. As far as I can tell, Zoom Technologies hasn't done business for over a decade, and it is certainly not the video conferencing startup that everyone was interested in the early 2020s. So with all that said, this hypothetical story doesn't sound great, but unfortunately, it's not a hypothetical. In the spring of 2020, thousands of hopeful investors flocked to the stock market to put their money into a company that they were sure was going to raise in price. And of that contingent, unfortunately, many of them bought stock in completely the wrong company. They bought stock in Zoom Technologies, which is, as discussed, a completely defunct company just because it had a misleading stock ticker. Totally understandable mistake, but one that probably hurt their wallets. It's also worth mentioning that to these investors' credit, they were totally right about the bet. Zoom stock, or rather ZM's stock, spiked during the COVID market, even breaking the $500 a share mark, and has declined steadily ever since then, now sitting at around $70 a share. Similarly, but even more sharply, look at this price graph for the Zoom Technologies stock. Note that massive spike in spring of 2020, followed by the immediate fall back to much less than 1 cent a share of price. This became such a trend that the SEC even had to step in and halt tradings for Zoom Technologies because of concerns about the adequacy and accuracy of publicly available information concerning Zoom, including its financial condition and its operations, if any. Since this whole mishap, Zoom Technologies has remained on the market, but has since changed their ticker to the much less confusing ZTNO. It's unclear whether this change was spurred by this influx of confused investors or if it was the SEC who did it, but I'm sure it all had a factor. So let's go back to that efficient market hypothesis. If the efficient market hypothesis was 100% correct, this whole mishap would have never happened. Investors all had access to the same information, and this information was that the video conferencing startup Zoom was under the ticker ZM and not the ticker ZOOM. Because investors all had access to that information, all you had to do was like 5 minutes of Googling to figure out exactly what stock you should be investing in. In a perfectly efficient system, no one would have poured their money into a business that wasn't doing business anymore. It's not to say the efficient market hypothesis has no merit. It's certainly true to say that individual investors are in a difficult spot trading against these big firms. You're trading against institutional investors who have state-of-the-art technologies designed to capture information as quickly as possible and trade on that information as quickly as possible. If you see a story on the front page of Google, you're probably too late to trade on that information and reliably make a profit from it. And this is not to mention the continued dominance of algorithmic trading and computer-managed trades. So, as with many things in life, the truth probably lies somewhere in the middle. Public financial markets are highly efficient and move at a lightning speed, but there are, and likely always will be, gains to be earned by trading wisely, predicting effectively, and of course, not making mistakes like buying the stock of the wrong company. This Zoom versus ZM debacle reminds us that it is always good to double check. Thank you so much for watching this video. If you enjoyed this breakdown of the story and want to hear more stories like it about business, sports, media, everything in between, you should subscribe right here on YouTube. Got plenty more video essays coming your way. I'll see you guys in the next one.